Welcome inside of my screen. So today we want to talk about chart pattern. In case you just come to channel for the first time, want to smash the subscribe button, drop a like, and don't forget to click on the notification bell so you don't stay updated when I drop some content like this. So what we're discussing today is want to discuss some chart pattern, how you can identify chart pattern, and how you can trade them profitably. All right. So there are three type of chart pattern that you can see in front of me. We have the reversal chart pattern, the continuation chart pattern, and we have the bilateral chart pattern. Now, reversal chart pattern are chart pattern that reverse the market entirely. Let's say price was in an uptrend. Let's say price was in an uptrend, creating lower high, higher high, lower high, higher high, lower high, higher high, and something like this form. I started seeing something like this. So, like this chart pattern that formed here now is a reversal chart pattern, which is also known as the head and shoulder pattern. So, this is a reversal chart pattern from the uptrend turn to a downtrend. So, same thing flip for the other side. If price was in a downtrend and you also see something like this, so reverse be the case, higher low, lower low, I mean higher low, lower low, higher low, lower low, then you see something like this, price come like this, then create this on out, then came, then turn. So this is a clear reversal chart pattern as well. So and the reversal pattern are chart pattern like the head and shoulder pattern, the the head and shoulder pattern, the inverse head and shoulder pattern. We also have the double top, the double bottom, the rising wedge or the falling wedge for reversal chart pattern. All right. But today we're going to be talking about the continuation chart pattern. That is what we're going to be talking about today. So with the continuation chart pattern, how if price was, let's say price was on an uptrend and you see price creating lows like this, high like this, and you are not in the trade yet, and you want to enter a trade, how exactly can you enter the trade so that you can take the next pull that is here to the upside with the chart pattern? So that's what we want to discuss today, a continuation chart pattern. All right. So the first we're going to be talking about in front of me of the continuation chart pattern, I'm going to be talking about the falling wedge. I've explained this falling wedge pattern many times in my YouTube channel. So guys, these are the chart pattern we're going to be talking about today. We're going to be talking about under the continuation chart pattern. We're going to talk about the falling wedge chart pattern. We're going to talk about the rising wedge, and we're going to talk about the bullish and the bearish rectangle pattern. And we're also going to talk about the bullish and the bearish peanut pattern. So all these pattern, I'm also going to show you a live example on the chart and how you can identify them. All right. So the first one, which is the falling wedge, so let's kick off the first one. So we're going to start with the falling wedge. The falling wedge pattern is a chart pattern that you can see in an uptrend. So when price is in an uptrend, creating lows and highs. So the falling wedge is the pattern that you can identify in an uptrend to get along and take it. And this is how the falling wedge pattern takes. So let me break it down for you guys. So the falling wedge pattern is once you see a impulse leg like this move up, then start seeing price start doing something like this, like a reversal. All right. So you can see this. So you can see this chart pattern here. So this pattern that is coming here, you can see that this a lower high, lower low, lower high, lower low, lower high. So this look like a selling. This look like a downtrend in an uptrend. So this look like a minor downtrend in an uptrend. So this pattern that is forming here is called a falling wedge, and this is how you identify a falling wedge. You map the first high you could see here, connect it to the second one, then drag it down. So then as well, you can clone this and you also put it at the bottom. So once you see price is trading inside of this channel, it means this pattern is what is a falling wedge, and you allow the price to continue going like that until you are able to see a break outside of it with an engulfing candle, a bullish engulfing candle, or sometimes you might experience something called a break and a retest of it like this. So at the retest, that's where you want to take your entry at this retest here, somewhere around there. Then you go longer. Then your stop loss just what go below the last swing you could see, which is this one. So I'm just going to put my stop loss below this one, and can have a risk reward of 1 to 5 on that. And how do you know your target for um a a falling wedge pattern. How do you know where to target? How do you know how to target where to put your hazel? I've just explained how to put your hazel, but how do you know your target? Now let's say you target the next resistance you could see. Let's say there's no resistance. The simplest way you can do it is for every impulse leg, when anytime you see an impulse leg like this, they start seeing some consolidation. When price want to continue with that move, you must see similar move with the previous one. You must see a similar move. So which is you're just going to calculate from this point here. This point started seeing the drop, this consolidation, this bottom here. Then I'm going to put it at the breakout. So you can see and is in line with my target. So that's exactly how you know how to target. So that's a risk reward of 1 to can give you a risk reward of 1 to 5, depending on the kind of depending on the kind of how the candles are, and depending on the time frame you are trading it. So actually, this pattern you can trade on any time frame, no matter the time frame you are seeing it, you can trade it. So this is a what a falling wedge. This pattern here, this one here is what called the falling wedge, and immediate downtrend inside a big uptrend. So it's just a correction. That correction is the falling wedge pattern that you want to trade. At the break of it, that's when you get an entry, then take it higher. So same thing for a bullish. Same thing for a rising wedge too as well. So it's just the inverse. So let's explain that of a rising wedge. So which is going to have something like this. Price was what in a downtrend with an impulse like this. Then started seeing some correction going like this. Started seeing this correction going like this. And at a point somewhere, you once you can see price has given you two places you can join your trend line. Just put one here, put one here, then drag it down. Then you can clone it. Also put it at the bottom. All right, put it at the bottom. So you could see this at the bottom. Then once price is still trading inside of that, you don't want to trade when it's still ranging inside of this pattern until you are what to clear a clear breakout, maybe kind of a retest. Then you have your target down, which I've explained how you get your target from year to year if you try to map it. So you just see the similar movement, and you're going to have a short trade on this, and which can give us a risk reward of, let's see what risk reward is going to give us. Our stop loss below the last low, and we go for, and this one you can see for this one is giving us a risk reward of 1 to 3. As I said, depending on how it happened, all right, depending on how the candles are and everything. You can see this one is kind of more bigger than that of this one. That's why you can see that the risk reward is different from each other. So that's just I just explained the falling wedge and also the rising wedge. The rising wedge is you see it in a downtrend. When price is in a downtrend, they started seeing some correction moving back like in opposite direction. So just put your trend line, wait for the break, have a break and the retest. Sometimes you might see the retest, sometimes you might see the day. But once you can get an engulfing candle closing outside of it, put your entry and make sure you put your stop loss below the last low. That is going to save your trade, and you just target your next resistance, or just use this formula I just told you guys, and you have your trade. So that is, now we've talked about the falling wedge, we've treated the falling wedge, we've talked about the rising wedge. So now let's go to the next one, which is going to be the what? Uh, so just going to pardon me. So I'm just going to bring this one here. So the next one is going to be so we've talked about this one, we talked about this one. So the next one is the bullish rectangle pattern. So we also have the bearish rectangle pattern. So we are going to talk about the bullish rectangle pattern first. So the bullish rectangle pattern is, and that one you'll be seeing it very well on your chart, especially this falling wedge and the rising wedge. You always see it on your chart, same as this bullish and bearish pattern. So this bullish bearish pattern is you see price moving. Let's say this bullish pattern, price moving an uptrend like this. Okay, sorry, excuse me. Price moving an uptrend like this. All right, creating highs, going higher. All right, so let me just bring this one here. Creating high like this. Okay, let me delete this and explain again. So you just see price, say let's say price was in an uptrend like this, all right? All of a sudden it gets to this point, you started seeing something like this, price started ranging, not creating highs, not creating lows. So it's not creating, neither creating high, never creating lows. So this is a rectangle bear bullish pattern. So you can see after this pull up, we have this correction, we had this pull up, felt as a correction, then start going up. Instead, price started ranging in that spot. So it doesn't mean price is reversing. It just what? It's also consolidating for the next pull up. Alright, so this one too, you're just going to clone it. And how do you trade this one too as well? Just like I've explained, that of this. How you trade this one too, you wait for price to break out of this rectangle. So sometimes you might see price doing like if it's coming down. That is a manipulation. So you let that manipulation happen, and once price get back inside, you're going to see something like this. So this exactly how angle pattern work. You are going to see price move to the upside like this, then come back to test somewhere around there, even sometimes in this middle, or sometimes here, then it go like this. So how do you get your target here? For heavy, now this formula to trade this one is different from that of how I explained the flag, the falling wedge and the rising wedge. This one is this consolidation you're going to use as your target. So, and this is what I mean. For every consolidation, for every pips accumulated during the consolidation phase, we also result to the pips that will be accumulated at the breakout of that consolidation. So what do I mean by that? This is what I mean. A breakout here, this was the range from here to, sorry, excuse me. So this was the breakout. This would be our ISL. And on this what I mean here. From this place to this place, that was the range. So I'm going to mark from here to here, and I'm going to what? Put it out to use as my target. And you know my target is just going to be something like this. And if you check that trade, I'm going to have a risk reward of 1 to 2. And that's still a better trade. Right? Or if let's say you are seeing a nice resistance or anywhere you can actually target it, but just what you trade your stops, you manage your trade as it is going. So that is a rectangular pattern just like this. And in some scenario, so let me just give another example where you just see something like this. You're going to have a massive pull up like this, then you have almost pulling back here, then you started seeing rectangle just in this middle, just here. So once you see situation like this, now this one will be a kind of confusing for you because this was the uptrend, this was a pull up, and this like a moving up, then started consolidating. Here you might be thinking, oh, maybe price want to drop further, a reversal. So what you just want to do is price is not dropping further, still the same pattern. Just make sure you clone this, you mark this point, then make sure you put it in the box. That's why you're putting this rectangle. That's why it's called the rectangle pattern. Wait for price to what? To break out. So once price break out, wait for price to break out like this. Once price break out, that's where you get your entry. Then you can target this previous high here. Sorry, that was a mistake. So you can target this previous high here as your target because this was previous high market get to. So price can was come there, create a double top, then fall. So it stay the same pattern. So it just depends on how you see it on the chart. So you might see it in this formula or you might see it in this format. So it's still the same thing. And price can what here create double bottom and drop off, or what shoot higher for a what for a higher high. But in the scenario that it does not create a higher high, then what we're going to see is what is a drop off back. That's a complete reversal pattern, but we are not talking about reversal today. So I'm just talking about the continuation pattern, which is what it has played out here with getting our entry here, and our TP was this high, and our stop loss was just below here, and that's give us a risk reward of what 1 to 4, and that's still a better winning trade if you ask me. So that is for the bullish pattern. So now let's talk about the bearish one. So I'm just going to move to the next slide. So let's talk about bearish one if it's first falling. So it's just the same thing, rectangular pattern. You see price, you're going to see price coming from a high drop off and do like this, drop off. Then at this point, it got here, then it started seeing some rectangle here. So once you start seeing the triangle, wait for the breakout, then enter the trade and target down here. So where you want to box is what is this point here. We want to box this guy. So at the breakout here, that's where you get your entry, and we have our entry here. We have to target to the previous high or go for a new high, a new low. The previous low, or go for a new low, then stop loss just below the previous swing. So or you just put it in the middle of the box. So most of the time I use it at the middle of the box, and I might just have my next target. It's going to be around this word of 1 to 4. So this is just how this trade works, and this how this trade works. Sometimes you might just see, let's say in some scenarios, I'm going to show you a live example of what I'm trying to say now. In some scenario, you see price was in an uptrend like this, then what came down, then went to this high, to this previous high, then started dropping, then is what started dropping, clear, take out this low, all right, take out this one low here, then pull back to this point here, inside here, then started ranging here. Yes, in some scenario you see like this, started ranging here. So just wait for it to break range. At the break of this range here, get your entry and target to this last low that was here. That's exactly what you want to target. So you're just going to put your entry somewhere like this. You're going to have a shot. You're going to put our entry here, our XL here, and our TP here. And that will still give us a better risk of 1 ratio 3. So still valid, so very much valid on that trade. So you might see it. So you might see it in this format. So you might see it in this format, all right? So you might see it in this formula. So there's different way you will see this chart pattern forming on your chart. So there's different way you see this chart pattern on your chart. There's different way. So all these possible scenario ways you can see it is just all as I've explained here for you guys. So you can see it. You have a different chart pattern here. So we've talked about the 4 chart pattern. We've talked about the bullish rectangular chart pattern. All right, so we talk about the bullish rectangle pattern, and we also talk about the bearish rectangular pattern. Now, the only one left is a pinot. And you see, for that of this pinot chart pattern, it always comes once in a while. It's hardly happen on the chart. To be honest, you hardly see this chart pattern forming on your chart. This particular pinot chart pattern. But this pinot, let me just explain both the bullish pinot pattern and the bearish one. All right. So I'm going to use this part to explain it. I'm going to move this green line. So let me use this part to explain it. So no, now we want to talk about the word the pinot pattern, both the bullish and the bearish. The pinot pattern, both the bullish and the bearish. So here we are talking about the pinot pattern. So here we are talking about the pinot pattern, both the bearish one and the bullish one. So the pinot pattern, like I said earlier, you hardly see them on the chart. They even hardly form. They only comes once in a while. But I'm going to explain the pattern, and anytime you see them, you will be able to recognize it. All right. So pinot pattern is, we have the bullish one and the bearish one. Pinot pattern, let's say price was in an option like this. All right, was in an option like this, creating highs and lows, creating highs and lows. And at this point, it's created high here. Then you will now start seeing something like this. For the peanut pattern, start seeing something like this. Alright, so if you can understand what I'm doing here. Now, this one here, you're just going to take your trend line, connect this one to this, and also connect this one to this. So this is what peanut sharp pattern. Now, some will call it you might say it looks like that of symmetrical triangle, but no, this is not symmetrical triangle. This is actually a peanut pattern. All right. So this is a peanut pattern playing inside of here. And how do you trade peanut pattern is, since price was in an uptrend, created a high, then came, created a low, then it what created a high again, then it's created a low, then we are expecting to create a high. Instead, it started ranging. Then we finally see that it's creating a peanut pattern. So peanut, for the bullish peanut pattern, it's actually going to break out for a impulse move to the upside. which is this part at the almost at the end, you're going to see a clear breakout like this. So for the peanut pattern as well, you can just use this previous pull leg to calculate your move from here to here, and most from here to here to use as a target. Now peanut pattern plays in two different ways. We can you can backtest this that pattern, look for it on your chart and confirm what I'm saying. It plays out in two movement way. The moment its first breakout like this went up, then sometimes, like most of the time, you now see price after it's taking your TP. Now, this is how you want to target it. So you just go for a wish word of maybe 1 to 3 or 1 to 4. So once you get that, close your trade. Peanut pattern is now going to come back like this again, somewhere around this place. Now, this is how it's going to come and do its own retest. Then to now go again. All right. So at this point, you can have a what a new entry around there, because you've taken the first trade, you are out already, you have taken your TP. Now you can have another what trade for peanut pattern and take it higher. Just just let your stop loss remain at the same point, and here you can have another better export, which is be around this over 6, because it's actually going to break this again and create a new high. This is how peanut pattern works, but most of the time they don't form. You hardly see them on your chart, so that's what I'm trying to explain. You hardly see this pattern on your chart. This is how they form most of the time. Or sometimes you just let's sometimes you let me give you another example. I just have a pull up like this, then a pull down like this, then you now see something like this. So now here we have this massive pull up, then the pull down. We are to see a breakout, but instead price started raging inside of this zone. So this also still what remain as the peanuts pattern. So that's why I told you guys that this is not what a symmetrical triangle. So you actually see this format two on your chart very well. Something like this will form most of the time. So you're going to see like this. So at the breakout here, that's where you want to take your entry, then take it higher, just like that. Of I've explained how you get the target, you put it for a target. I've also explained how you put your stop loss. So once you enter this trade for a long here, long is here, then we have our stop loss below here, then our target all the way high there. And that will give us a risk score of 1 to 4.6. So let me just calculate it. Are we having exactly the same thing? So I even go higher, yes. So that's giving us a risk score of 1 to what? 1 to 5. Let's just say 1 to 5.41. So let's just say 1 to 5. And that's a better risk to what? So this is how you see the peanut pattern, chart pattern forming sometimes chart, and this is how you can trade it. So you might probably see this kind of peanut, or you see this format, it's still the same thing. So that I say it's not a symmetrical triangle. If you talk about symmetrical triangle is actually going to start. If you want to mark that of symmetrical triangle, you are going to have something like this. So let me and symmetrical triangle is a bilateral candlestick formation, chart pattern formation, which I'm going to explain in the next video. So I'm not going to be talking about symmetrical triangle today. So this one is it night. You see that will break to this side. Let me just put this one well. You see that will break to the upside or break to the downside. So that's why I call it bilateral. That's it breaks in either direction. You see that it comes here or it comes here. So it's anywhere it breaks to, that's when you want to follow. So this is symmetrical triangle chart pattern. But this we are not talking about symmetrical triangle today. So I'm just going to delete this one. So what we're talking about is the peanut. I've just explained the bullish peanut for you. So same thing as the bearish peanut, same thing as the bearish peanut. You're also going to see similar things, similar one on the bearish peanut. I wish I can reverse this, so I'll just reverse it and use it to show you the example. So same thing, just as I've explained it here. So same thing you are going to see on the bearish one. So the bearish one is going to be a drop off, and it comes like this, then you start seeing something inside of here doing like this, doing like this, like this. So until what? Once you start seeing this consolidation, just pause your trade, then wait for a clear breakout outside of here. And once you can have that clear breakout, that is when you want to get in back this trade. Alright, so this this is a peanut pattern. They hardly form. So the one that form most of the time is this Mexico triangle. This peanut pattern hardly form. And once it form is what? We have what? our clear breakout to the downside. So you're going to have a move to this point, and this is going to be your what? Your entry here. LZ just there, and the TP we just go for next resistance. You can see it's like in this scenario there's a resistance here, so we can just go for that resistance, and our stop loss just above that. And we also have a reach word of 1.2. So that is just the bullish pattern, the bearish peanut pattern, and the bullish one. So we just talked about the peanut pattern. So is there any pattern we've not talked about? So let's just see on our chart. So actually we've talked about everything, and I think this brings us to the end of the